Hello, I'm David Hardesty. In this lecture, we continue our discussion of website development costs with a discussion of the rules for startup costs. The objectives of this lecture are to learn when a website development activity constitutes a startup activity subject to Section 195, understand the types of costs that must be deferred under Section 195, and learn to amortize deferred Section 195 costs. Let's first look at an overview of the rules for startup costs. Startup costs are generally subject to Section 195. Under Section 195, expenses that are otherwise deductible are deferred during the startup period. This rule mainly applies only to ordinary and necessary business expenses under Section 162. Certain currently deductible costs are not deferred. Chief among the deductible website development costs that are not deferred are Section 174 expenses. Costs deferred under Section 195 are amortized over 15 years, beginning immediately after the startup period ends. The first step in applying the rules for startup companies is to determine whether an entity is subject to Section 195. As discussed in the text at 7.043, Section 195 applies to costs incurred in investigating a new business and costs incurred in creating a new business. Section 195 does not apply to costs incurred to expand an existing business. Whether there is a new business or the expansion of an existing business is based on facts and circumstances. The determination is based on individual judgment. Accordingly, reasonable people can disagree as to whether or not an entity is subject to Section 195. This means, then, that the determination is inherently uncertain. For examples of cases of the expansion of an existing business, see the text at 7.043a. And for examples of new businesses, see the text at 7.043b. Here's an example of a new business startup subject to Section 195. See the text at 7.043b. Toys Inc. is a long-time maker of educational toys. Its historic business has been to manufacture toys which were sold to wholesale distributors. The company created a new website to sell its products directly to customers. In this example, factors to consider in deciding whether there is a new business or the expansion of an existing business are: the taxpayer has embarked on a new way of selling its products and is selling to a new customer base. Conclusion: creating a business to sell products in a new way to a new customer base has been construed as creating a new business and is not the expansion of an existing business. Now, let's look at the expansion of an existing business which is not subject to Section 195. This example is in the text at 7.043a. Parts Inc. is a long-time mail-order seller of auto parts. It creates a new website to sell its products. The website is essentially an online Parts Inc. mail-order catalog. The website and the mail-order catalog, while having different order entry systems, share the same accounting, inventory, and delivery systems. In this example, primary factors to consider in deciding whether there is a new business or the expansion of an existing business are the taxpayer selling the same products to the same customers, but selling them in a different way. Conclusion: in this example, because the taxpayer is selling the same products in a new way to the same customers, the creation of a website appears to be an expansion of the taxpayer's existing business. Therefore, Section 195 does not apply. Once you have determined that an activity is subject to Section 195, the question is, what costs must be deferred under this section? As discussed in the text at 7.042a, Section 195 costs are those costs associated with investigating the acquisition or creation of an active trade or business, plus costs associated with the actual creation of such a business, but only if the costs would be deductible as ordinary and necessary business expenses if incurred by an existing active trade or business, and the costs are not deductible under Sections 163a, 164, or 174. Here is how to apply these rules in identifying Section 195 costs. First, identify costs that are deductible under specific code sections. These include Sections 163a, 164, and 174. Identify costs associated with the organization of a business enterprise that must be deferred under Section 248 or Section 709. Identify costs that must be capitalized under Section 263 or 263a. The remaining costs should be those that would be deductible if incurred by an active trade or business. That is, they should mostly be costs that an active business would characterize as Section 162 costs. These remaining costs are Section 195 costs. Here is an important point regarding depreciation and similar deductions incurred by a company subject to Section 195. As discussed in the text at 7.042, depreciation, amortization, and cost recovery deductions are generally not allowed during the startup period, so these are not Section 195 costs. As an exception, such deductions are currently allowed when they are incurred in connection with 174 research and experimentation activities, in which case the costs are Section 174 costs and Section 195 does not apply. Once we've deferred Section 195 costs, we have to start thinking about amortizing them. Amortization begins when the startup period ends and active business operations begin. Active business operations begin when the business entity has begun to function as a going concern and perform those activities for which it was organized. As explained in the text at 7.044, costs deferred under Section 195 are amortized over 15 years, except for de minimis costs, which are currently deducted. As explained in the text at 7.045, if a trade or business is completely disposed of by the taxpayer before the end of the Section 195 amortization period, any remaining deferred expenses can be deducted to the extent allowable under Section 165. Here's an example of the determination as to when the startup period ends and active business begins. See the text at 7.041. Jewelry.com is a web-based organization building a site to sell jewelry. The website incurs Section 195 costs from January 2000 to June 2000. The website is not yet ready to sell jewelry because its transaction processing software is not yet complete. However, the developers decide to put the site online anyway with pictures of products and telephone order information. Here's an analysis of the determination regarding whether the startup period has ended. While the website is technically live, it is not yet performing those activities for which it was created. It is not fully functional until it is able to take and process orders online. In the case Richmond Television, discussed in the text at 7.041, the period for starting up a new television station did not end until the station could perform all of the functions for which it was organized. Likewise, Jewelry.com is probably not yet an active business until it can perform all of the functions for which it was organized, including taking and processing orders online. Therefore, the fact that Jewelry.com was accessible through the internet does not mean the startup period has ended. Once its transaction and processing software is fully functional and ready to take orders and is accessible by customers, then the startup period can be said to have ended.